Welcome to PSG Asset Management with me, Joanne Baynham, independent moderator. Today I'm chatting to Lyle Sankar, head of fixed income at PSG Asset Management. Lyle, I'm going to dig a bit deeper. Talk to me more about your integrated approach to running money and how the team assists in generating these returns.
Sure. So, this PSG aim or PSG Asset Management way of managing money, this has been around for more than 20 years. So this is the same way we manage money in equities, we manage it in fixed income. So really the focus there is on a philosophy of risk first, so not losing clients' permanent capital or avoiding permanent capital loss, and then looking for mispriced quality. And if you think about the fixed income context, that really suits a fixed income investor. You're looking to safe place to put your money, and then risk-adjusted yields, yields that compensate for prevailing market risks. And I think with that one integrated process, we're able to deliver across asset classes.
Okay, so let's go back to basics here. Give me an example of something that works in the integrated process that made you avoid a loss or have an outsized gain. Either one of those examples where the team came together and said, this is a good idea. Give me some ideas of what that is.
Sure. So, we run a team-based approach at PSG Asset Management. We're about almost 20 investment professionals now. And so when we're looking at a company, we're looking at the equity lens, and we're looking at it from a corporate bond lens as well. And so there's been many ideas where we've owned it on the equity side, but particularly maybe we haven't had a favorable view from a bond perspective. So I'll use Steinhoff as an example. It's an old example in the SA space, but this is one where we avoided it in both the equity side and in the fixed income side. And one, it was really being able to do the balance sheet work on the fixed income side, but then saying on the equity side, that actually is critical for this investment case. Let's avoid it in both, both franchises. So that's been one area where it's been absolutely instrumental in, ensuring a longer-term track record that's sustainable in fixed income. So avoiding that pitfall. And then I guess there's many examples of where we've done really well. I think, government bonds for us, we find that the market has a very short-term focus. If you look back since Nenegate, since real yields have been high in SA, attractive inflation-beating yields, we've taken a longer-term view on bonds. We've been invested since Nenegate. And essentially, if you just look a little bit longer than 1 year out, ignore sort of the short-term volatility, you've almost always had a positive return, and you've earned very good, attractive inflation-beating returns. So that's a philosophy that sits in both teams. It's not really often where you hear fixed income guys say, let's look a bit longer, but in certain asset classes, it really benefits you to sort of put the short-term noise aside. And as a result, our funds have done really well in this asset class, managing risk, but then producing that inflation-beating return.
I have to chuckle a little bit, though, because when I think of 3 M's, it's the margin of safety, moat, and management. And what you're doing as a fixed income investor is lending to the South African government. Talk to me about the management there.
Yeah, fascinating. I think it's probably important to break that into 2 different periods. Let's call it pre this administration that we're dealing with now. I think you would have had a lot less trust politically, and politics will always play a factor in SA investing as a whole. And particularly in fixed income. But what we are saying when we look at bonds and yields, we're saying firstly, inflation is the biggest driver. And your monetary policy is going to be one of your management teams. So the SARB, we'll look at the SARB and we'll say, are they independent? Are they managing monetary policy credibly? And we can tick that box. And then fiscally, we'll say, okay, what is National Treasury doing? And there is a degree of independence. It may be limited from time to time from politics, but there is a degree of independence. It's a credible framework, and then we want to assess whether that's sustainable. And I think a lot of the opportunity actually lies in maybe investors overweighting the politics and sort of ignoring some of the key drivers. That's actually over time. Politics will change and it will fluctuate, but these things are going to be what determines your 10-year outlook.
Okay, so I'm picking up a lot of the market has a view, we have a view from what you're telling me. What do you think your edge is at PSG? What sets you apart? What makes you better than everybody else? In a kind of a nutshell, is it your behavioral aspects of why you run money? Is it your information ratios? Just in a nutshell, what is it that gives you the edge?
Yeah, I think it's a few things that, we try to do on a day in and day out basis and try to be repeatable and consistent. But for me, the key element that I would pick out is we're not going to sit here and say we can forecast short-term data perfectly. We actually spend very little time on that. We try to look longer term. The second part is, you touched on behavioral, and I think it's underweighted. It's actually a very key edge for us. And it's from junior analysts all the way to chief investment officers. You've got to have the willingness to approach risk, looking for the opportunity, but then also when the margin of safety isn't there, be able to walk away from opportunities. And for our team, we try to think about where things can go wrong and how we can protect capital, but then also focus equally on where things can go right and where the market's mispricing the opportunity. And if you do that repeatedly and consistently, I think you get 6 out of 10 right. And that's going to get the odds in your favor over time.
I think I've seen a stat that says if you're 51% right most of the time, you're going to be top quartile all the time. And let's face it, fund managers often make mistakes. So I think 6 out of 10 is an incredibly good hit ratio. Okay, and one of the things you and I talked about, like off camera, is this: you're very anti-corporate bonds at the moment, and you particularly didn't like the view of them having a high Sharpe ratio. Can you explain to us what you're talking about?
Yeah, so you speak very close in that description. I think when we're looking at corporate bonds, we want to buy them when the spreads are high. So you're going to get a yield above JIBAR or above cash rates. We want to buy them when we think the market's mispricing the risks of a corporate. Today, we see none of that. So we see very tight spreads because so much capital has moved to the income space. And if you think about it, if you're not going to buy government bonds and your SOEs are not doing really well, all that flow is moved into corporate bonds, and corporates in South Africa are not issuing bonds. So what it's meant is that compensation has come down. It's not risk adjusted in our minds. And that market's so small that I would classify it as fairly liquid. So what you get is, despite what happens in the market, it really trades. It doesn't trade sufficiently to reflect underlying risk. And so for us, what you get from it is if your portfolio is fixed, focused on corporate bonds, you're going to get almost the straight line performance, but it doesn't really reflect true reality of what the risks are. And from time to time, you see that come out. So we'll go back to 2020, and most will forget now that we actually had Land Bank and SOE that was in most fixed income portfolios defaulting. Subsequent to that, we saw very little remarks downwards. The pricing doesn't move out. And we're seeing some of those scenarios now. And it worries us a little bit that there's this big focus on Sharpe ratios, and we don't think Sharpe ratios equate to risk adjusted. We think it can be
because these things don't price.
Essentially,
is what you're telling me.
You're not buying an asset that's non-correlated to the market. It's just really it doesn't price. And I think most will forget in COVID these assets actually froze. And it was a liquidity constraint.
Very quickly, just to end off, you guys do something slightly unique in the marketplace, from what I can understand, where a lot of fixed income managers buy local property for additional yield. You do something slightly nuanced. Tell me about it.
Yeah, so you're talking about our flagship fixed income fund. That's the PSG Diversified Income Fund. It's really a portfolio that we think is in the sweet spot. So if you think about the needs of an income investor, they want capital preservation, we tick that box. We want to ensure we always tick that box. But then you want a very attractive income return that you can get from various sources, so well diversified. So when you're thinking about what that fund can do, is we uniquely in the space target an inflation plus benchmark, so CPI plus 1 after fees. So really our key focus is to beat inflation, and in that we think you'll beat cash returns and you'll beat the money market space, and over time you're going to get a little bit of growth alongside that. So what we do that's unique in the space is obviously I think you have a good understanding of how we manage fixed income, how we actively manage across asset classes, using all asset classes, all curves, so inflation-linked bonds, NCDs, nominal bonds, really focusing on where we can get the best risk-adjusted returns for the funds. But then That's going to get us to our core fixed income portfolio, and this is a local fixed income portfolio. What we then do in addition is we use a small allocation to equities, property, preference shares from our globally integrated process. It's an edge that we think we have in the space. Typically, guys buy property, local property. It's correlated to government bonds. We think there's a better way to do it. Open the toolkit up and say, how can we get many different drivers of return and mitigators of risk as well. So it is an edge that we think we offer, and we've been doing it for about 8 to 9 years in the space. We've yet to see sort of a fund apply that strategy.
Okay, give me a tip. Like, what equities are you buying? Are you
Sure.
buying BTI? Are you buying BAT? Well, come on, give me some color here.
Yeah, so I think it's not very complicated. This is.
Give me one example, Lyle.
I'll give you one
stock.
example. So it's not very complicated. We're looking towards our equity team. We're not buying the full buy list. We are not buying a portion of our equity fund. We're selecting ideas that complement our fixed income portfolio. So firstly, let's buy the best fixed income portfolio that we can, and then ask the question, do we need these? And do we need those other asset classes? Can they add a little bit to that extra real yield? So to think about it in context, today we can build a fixed income portfolio that will yield 9%. Now, all we're asking of the extra or the other asset classes just to add that extra 0.5%. It's not going to be the biggest driver, and we're going to try and select ideas that either give you a dividend yield that's attractive, something that's non-correlated to SA. I'll give you two examples now. But I think it's a strategy that over time, naturally equities will drive real returns, and that is our focus. So I'll give you two examples. Something that we've liked in recent years is Philip Morris. It's a tobacco company.
And what
offshore.
yield are they on?
So they used to be on an 8% dividend yield.
In sterling?
In dollars.
In dollars, sorry, dollars, yeah.
Now, what's great about that is obviously, 3 years ago, you couldn't get a yield in dollars. Secondly is when we look at it, it meets our 3M criteria of moats management, margin of safety. We're very happy with it. We think it's asymmetrical, so it's cheaply priced and you're getting this dividend yield. But it's got absolutely nothing to do with local fixed income in South Africa. So you're bringing in this return driver and this risk mitigator that it's non-correlated to SA, and it's just, it's another cylinder that will fire at a different point in time.
I think just so for the audience listening to this, it's very clear, it's a very small portion of your portfolio. It's a little bit of an extra yield, but it's not what you stand for. It's just a little bit of interest. And I think I like the fact that you're doing something slightly different in the market that tends to buy local property, and you're doing something that's quite unique. So, Lyle, I'm going to have to cut you there because we could talk all day. Thanks so much. Well done.